Many investors choose to buy dividend stocks for the reliable and growing dividend income. And if you're closer towards retirement, then getting that solid dividend yield is very important. But you don't have to sacrifice total return in order to get a high-yielding dividend stock. Today, I'm going to share 5 high-yielding dividend stocks that you can feel comfortable buying and holding forever. These are companies that continue to grow their dividend payments over time and actually have a pretty good total return. I found these stocks by using my stock screener over on dividenddata.com. Here you can ask really any question about stock analysis, but if you specifically ask to find stocks based on certain financial metrics, then you'll be able to use this dynamic stock screener I'm showing today. Here you can filter by hundreds of possible financial metrics. And what I'm using today is stocks in the United States with a dividend yield over 4.9% and a 3-year dividend CAGR over 3%. For stock number 1, I'll pick the Altria Group, ticker symbol MO. Those of you familiar with the channel will recognize this stock as it's the number 1 high yield dividend stock in my dividend growth portfolio. It pays me $2,236 of annual dividend income, and I've bought the stock with a very good cost basis, so I have a 9.51% dividend yield on cost, and I have earned 84 shares from reinvesting dividends, boosting my dividend yield on initial cost basis to 11.23%. Currently, I have a 51.77% total return on my Altria stock investment. That's not bad at all for a high-yielding stock, especially since they're still down a lot from their 2017 high of $77 per share. But what I like about Altria stock is they trade at a very low valuation and they consistently grow earnings per share, free cash flow per share, and dividend per share at a slow, reliable rate. The 5-year compound annual growth rate for free cash flow per share is 3.44%. The Altria dividend is growing at a 6.97% 10-year compound annual growth rate, and lately they have been growing the dividend in low single digits. The most recent increase was 4%, with the one prior being 4.26%, and the one before that being 4.44%. This is a sustainable payment too, with a 74.5% free cash flow based payout ratio and an 83% net income based payout ratio. And Altria actually has an extremely long history of consecutive dividend increases. This drop off in March 2007 and March 2008 were not actually from dividend cuts. Instead, they were from the spinouts of Kraft Foods and the spinout of Philip Morris International. If you take that out, then Altria is actually a dividend king. And while the majority of their cash flows go to pay dividends, they even buy back stock. In the past 2 years, they've decreased shares outstanding by 1 to 2%. Analysts are projecting low single-digit growth of earnings per share over the coming years, and that will lead to reliable dividend growth for Altria. And here you can see that I asked Dividend Data about Altria stock's dividend yield. And by the way, if you're a user, you can switch between the yield, the dividends, and the total return for this chart. And over the past 10 years, there has been significant buying opportunities to get Altria stock at a 9 to 10% dividend yield. For example, from fall 2023 all the way through spring 2024. I was buying the stock then and making videos about it on the channel. However, I have stopped buying as the stock price has gone up over the past few months. And I think part of that is from a market rotation and expectations that interest rates will continue going down. That lowers the risk-free rate of return and makes high-yield dividend stocks like Altria a little more attractive if you're looking for reliable income. People often say if you are aiming for total return, you should not look at high-yield dividend stocks and instead focus on growth. And I definitely have a lot of my portfolio optimized towards dividend and free cash flow growth. But that doesn't mean a high-yielding dividend stock can't get a great total return. Over the past year, Altria stock has a 49.58% total return. That's from stock price appreciation and dividend reinvestment. However, the 10-year total return is not that great at 112.52%. And the reason why was that Altria's stock ended up being deeply overvalued from 2015 all the way up to that 2017 high and all the way through 2018. And I've covered this before in my Altria stock review videos. A lot of that is from their Juul acquisition. People were hyped up about that and thought it would be growth, but it ended up being a complete disaster. And over the following 5 years, they basically wrote down the entire Juul investment and lost all that money. However, the stock price became very reasonably priced after that, and it traded at a very low valuation. And on a relative basis, it still trades at a pretty low valuation. Earnings per share today are much higher than they were in 2017. Dividend per share is much higher than it was in in 2017. And this is a very important point about investing and backtesting total return. The only thing that really matters is the price that you buy at. You're not buying it in 2017. You'd be buying it today, or you'd be buying it when I bought it at a 9.5% yield. And yes, Altria is a cigarette company. That is where they make the majority of their cash flows from. And you'd be right to assume that in terms of volume, that's a declining business. And cigarette volumes have been declining for decades and decades. However, Altria has continued to generate very high free cash flow, and that has only grown over time. Since 1990, when cigarettes were already on the decline, Altria has generated a 10,400% total return. And a big part of that is due to the power of dividend reinvestment. You should not underestimate the long-term compounding power of reinvesting dividends. And Altria is actually a far older company than 1990. I've seen some sources in the past that say that Altria is the highest total returning stock of all time. And that seems roughly accurate. By the way, if you want to use the stock research tool I'm showing throughout the video, then sign up at dividenddata.com. There you can ask Dividend Data to write you a research report on Altria stock, and it will tell you everything you need to know to invest in the company. And this is all sourced from real-time financial data and actual earnings transcripts and quarterly reports. It can generate analyst price targets. You can view revenue by product segments, and of course the dividend history and yield charts that I was showing earlier. And that's really just the start of what you can do with dividenddata.com. I want as many people to try this new AI analyst as possible. That's why I'm doing a 50% off sale to celebrate the launch. Click the link in the description and pin comment, and you can lock in 50% off for life. Or if you sign up via the web app, then click your plan and enter the promo code AI at checkout to get 50% off. That's the promo code AI. For stock number 2, I'm going to pick another stock I have in my portfolio, Enterprise Product Partners, ticker symbol EPD. I have not bought this company recently, and they're one of the smaller stocks in my account, but I have a 109% total return since purchase, and a large amount of that is from reinvesting dividends. I have 36.3 shares from reinvesting dividends. And despite it being one of my smaller positions, it's actually my 6th largest dividend payer, earning $284 a year. And my yield on cost is 10.5%, and from reinvesting dividends, that has been boosted to 14.46%. This is a company trading at a relatively low valuation that slowly grows earnings per share over the long term. And they're consistently growing that dividend payment. The 10-year compound annual growth rate of the EPD dividend is 3.7%. This has accelerated in recent years, with the 3-year CAGR being 5.27%. This is a quarterly dividend payer, and they are currently doing a dividend increase every other dividend payment. The latest was 1.94%, with the one prior being 3%, and the year prior to that, they did 2% and 3.1%. And they do pay out the overwhelming majority of their cash flows as dividends, but it is sustainable. Payout ratio based on free cash flow is 99% in fiscal 2023, but in the 60% for 2021 and 2022. And based on net income, it was 77% for fiscal 2023, and it has been in that healthy range in recent years. You are also not being diluted, as shares outstanding have remained flat. And what does EPD actually do? They are a midstream energy service provider of natural gas liquids, crude oil, petrochemicals, and refined products. And the majority of their business is transportation of these liquids through pipelines. If we look at a breakdown of their revenue, the top 2 by far are natural gas liquid pipelines and crude oil pipelines. The next largest is petrochemical and refined products, the smallest being natural gas pipelines. And here you can see the breakdown over the last year. And your dividend yield for EPD stock is highly dependent on when you bought it. For example, I bought the stock in 2020, and that was the best time by far to buy EPD. In fact, that would be historically the highest dividend yield other than during the great financial crisis of 2008 to 2009. And because of that, my total return is actually much higher than the 5-year total return of 73%, because I bought it from this depressed range in 2020. And if you had bought EPD stock exactly 10 years ago in November 2014, your total return would not be that good, only at 63.14%. And that's because that was literally the worst time to buy. EPD was trading at its all-time high stock price that it still hasn't hit. Coming out of the great financial crisis, the stock rallied over the next 7 years, and if I remember correctly, there was a large surge in natural gas investment during that time. So remember, if you're buying EPD stock today, you're buying it today. not in 2014. The business is generating higher earnings and a much higher dividend payment. But in the entire history of EPD stocks since going public in July 1998, they have had a 3,200% total return. That's pretty good. Definitely pretty solid. But the one thing you need to know before investing into EPD is this right here. LP. Limited partnership, and specifically EPD is a master limited partnership. So I asked Dividend Data what this means, and you can do the research yourself as well. But the gist of it is that it will not count as a qualified dividend. And also on your taxes, you will be sent a K1 form, which does add some slight complications. I've done this now for a number of years, and it really isn't a big deal. When you're just doing your taxes, you just check another box basically. But if you like to do your taxes earlier, some companies are a little late sending their K1s, and it's different on a company by company basis. So just be aware of that. And some people just avoid investing in MLPs altogether. Again, I don't really know very much about taxes, but I have not had trouble with this. For stock number 3, I'm going to pick Realty Income Corporation, ticker symbol O. And this is famous for being known as the monthly dividend company. They actually have that trademark. And as you can see, Realty Income pays a dividend every single month. So a lot of investors really like that. They also grow that dividend multiple times a year. The 10-year compound annual growth rate of the Realty Income dividend is 4.04%. And this is a company where the stock price over the long term has trended up, earnings per share have continued to grow, and you get a pretty solid dividend yield currently at 5.54%. This is an extremely reliable payment too. The payout ratio based on free cash flow is consistently in a safe range around 70 to 80%. However, based on net income, the payout ratio does seem to be unsustainable. But Realty Income is a real estate investment trust, and payout ratios can get a little finicky there. Realty Income continues to grow. The 5-year CAGR of revenue per share is 5.13%. Free cash flow per share is growing at a 6.21% 5-year CAGR. And this is growth while they have had acquisitions that increase their shares outstanding. So if I was looking for reliable, growing monthly dividends, Realty Income is where I would look. So here we have Realty Income, the monthly dividend company. I should also mention that it is a member of the S&P 500 Dividend Aristocrat Index, and that is any company that has increased their dividend payment on an annual basis for over 25 years. And as I was mentioning earlier, when you're valuing a REIT, you sometimes need different financial metrics, and for REITs, AFFO is the #1 way to measure profitability. That is adjusted funds from operation. FFO would be funds from operation. And by the way, if you don't know some financial term, just ask Dividend Data. If we look at the dividend yield for Realty Income over the past 10 years, this current 5.6% yield is on the higher end historically. However, you could have bought the stock for as high as a 6% dividend yield during the early half of 2024 and fall 2023. The total return for Realty Income over the past year is 15.61%, and before this recent sell-off was 30.64%. The 10-year total return is 102.97%, which is not the best, but again, exactly 10 years ago was not really the best entry point for Realty Income. Since 1994, the stock has had a total return of 4,140%, and that's a pretty great total return for 30 years. However, if the past 10 years are predictive, then it may not grow like that over the next 30, but only time will tell. But what you do know is that you'll get a reliable monthly dividend payment and a 5.5% starting dividend yield that will grow from that base. For stock number 4, I'm going to pick MPLX, ticker symbol MPLX. And this was an interesting company I just discovered recently. And the reason why they came on my radar was because of their very high dividend growth and high starting dividend yield. MPLX is another pipeline company and a limited partnership, so it will likely have a K1 similar to EPD. But with MPLX, you're getting much higher dividend growth. The 10-year CAGR of the dividend is 10.34%. The most recent dividend increase was 12.53%, with the two prior being 9.6% and 9.9%. And again, that's that high of growth with a current 8.39% dividend yield. I would also like to mention, with all this volatility around their stock price over the years, the MPLX dividend has only continued to grow in that time, and they did not ever suspend or cut their dividend. The payout ratio is sustainable too, with a 73% free cash flow based payout ratio and an 83% net income based payout ratio. MPLX is described as a midstream energy infrastructure and logistics company. They primarily operate in two segments, logistics and storage, LNS, and gathering and processing G&P. And my AI analyst concluded that MPLX demonstrated strong financial performance and growth prospects supported by strategic investments in key basins and robust cash flow generation. The company's focus on expanding its midstream infrastructure and logistics assets, coupled with a solid dividend yield and consistent distribution growth, makes it an attractive option for long-term investors seeking stable income and potential capital appreciation. It also highlighted the major risks being fluctuations in commodity prices, regulatory changes, and operational challenges in executing growth projects. It also mentioned the higher payout ratio and leverage. And I didn't know this. One thing I found interesting here is that Marathon Petroleum Corporation, which is a stock I've looked at before, is actually the highest owner of MPLX at 63.43%. So I'm actually learning this live. I'm thinking the MP might stand for Marathon Petroleum. And that actually makes me feel a lot more comfortable knowing that a large corporation like Marathon Petroleum has an invested interest in MPLX. Marathon Petroleum is a $51 billion company that had massive earnings over the past few years. And they're even a little bit of a dividend growth stock themselves. Let me know in the comments if you want me to do more research into MPLX and possibly a full stock review video. So the current 8.38% is actually on the lower end historically. And think about this for a second. During 2020 in the oil crash, you could have bought the stock at a 15% plus dividend yield for an entire year. And during March 2020, it got up to a 32.82% dividend yield. 32% for a company growing their dividend payment 10% a year. The 1-year total return for MPLX is 38.97%. The 3-year total return is 93.29%. And the 5-year total return is 234%. And that's if you bought it before the COVID pandemic. If you had bought it during the crash, your total return would be massive. However, as I've mentioned before, even with EPD, the 10-year total return is not very good. 57% for MPLX because the stock was overvalued at that time. And this is something we should remind ourselves a lot, that the price you get in is what really matters, especially for a lower growth company. If you're a business where you're growing revenues 50% a year, then it doesn't matter as much 10 years from now when you got in. But since going public in 2012, the stock still has a total return of 313%. So not bad even with those few years of overvaluation. For stock number 5, I'm going to pick VICI Properties, ticker symbol VICI. This stock went public in fall 2017 and quickly became a favorite among dividend investors. And that's because of its high dividend yield and growth. The dividend yield for VICI is currently 5.53%, and the 5-year compound annual growth rate of the dividend is 8.51%. However, this has slowed down, with the most recent increase being 4.22% and the one prior being 6.41%. So dividend growth seems to be slowing at VICI. It is sustainable though, with a 70% free cash flow based payout ratio and even a sustainable payout ratio based on net income. But what investors really fall in love with VICI is the properties they own. For example, you have the Caesars Palace in Las Vegas, the Venetian, MGM Grand, Harrah's Las Vegas, Hard Rock Casino, the MGM National Harbor. They're also in the golf business too. So what investors really like is you can own a piece of these exclusive properties. This is rather unique for a public stock. So again, VICI is a real estate investment trust, so you don't get the benefit of qualified dividends, which means dividends are taxed at the lower long-term capital gains rate. The current 5.5% dividend yield is in line with recent history, and the only point where this was a major outlier in terms of yield was during 2020, and that impacted pretty much every real estate investment trust. Since going public in fall 2017, the total return for VICI stock is 139.82%. That's from price appreciation and dividend reinvestment. Over the past year, the total return is 13.48%, so it is underperforming the market. That's also true over the past 3 years, with a total return of 23.66%. But VICI is no doubt a very interesting portfolio of real estate, and they are poised to continue growing their dividend payment with a current yield of 5.5%. So those are my top 5 high yield dividend stocks to buy and hold forever. And again, if you want to play around with my stock screener over at dividenddata.com, you can filter by hundreds of different financial metrics and look for stocks that fit exactly what you're looking for. And if you sign up at dividenddata.com, you can use my new AI chat tool and all the other research tools I was showing throughout. And you can currently lock in 50% off for life. Just click the link in the description and pin comment, or enter the promo code AI at checkout if you sign up via the web app. If you enjoyed the video, leave a like, subscribe to the channel, and thanks for watching. See you next time.